The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen, and welcome to this Danielcode webinar. Nice to have you with us. Good afternoon to our friends in New Zealand. Just good afternoon, good morning to our colleagues in Australia. Great to have you all with us. How's the sound? Anyone? Give me a blast on chat, would you, under posting the questions box. Tell me if you can all hear the sound all right. Everyone happy with that? Don't have anything yet. Where are we? Good. Okay, Andrew, thank you. Yes, we do. And my friend Chase. Chase is with us. And Dex. Yeah, good Lord, I haven't seen you for a long time, mate. Dex, great to have you here. Pete and my mate Pete Andrews. First bloke I ever taught at a tutorial. Peter Andrews, a farmer in New Zealand, very smart bloke. And happy to have him with us. John Barnes from Canada. John's going to be with us in Los Angeles in about a month. The next tutorial, folks, is about a month. So good to have you here. Hey, just a ton of stuff to talk about today. A lot of this is going to be just all the horrors and hates and the other trading killers. And of course, let's just see who else is here. We've got a good crowd here today. We always do. Don't want to miss anyone here. Don up in Canada. Don Maydell, nice to see you. The lovely Sage, Sister Sage, has been the subject of some comment on the forum lately. Greg Palladini. Greg, I think I got an email from you. Greg, you're going to do a video tutorial, if my recollection serves me right, and you had a question, which I better deal with now, if you'll just bear with me, folks. And Greg's question was, is the video link, when you're doing a video tutorial, no, it's not alongside the live sessions. Greg, we don't record that and broadcast. It's a one-on-one with me. Personally, it's not recorded. It's all live. And you'll have your 4 2-hour sessions with me. I'll teach you everything that we teach at the live tutorials. You'll get all the Danielcode programs that they get at the live tutorials, exactly the same, except I don't have the pleasure of meeting you. And you probably miss out on some of the fun we have at tutorials, because we do have a whole lot of fun. And I got to tell you, the senior bartending lass, just excuse me a moment. I've got forgot to turn these phones off. Just bear with me, folks. Okay, back online. Excuse me, I've done so many webinars for clients lately that I forgot to run through my checklist and make sure the phone wasn't ringing in this office, so forgive me. So Greg, yes, they're all one-on-one with anyone who's doing a doing a tutorial by video. We're sorry you can't come to the live ones. I love to meet you and form a relationship, but if you can't, next best thing is do it by video. You'll have 4 2-hour sessions with me, one-on-one live, and then you will hook into the 4 follow-up webinars that we have for tutorial attendees, which run over the 2 months after the tutorial. Make sure everyone's up to speed and actually using the tools that I teach you and implementing them properly. All of this will be recorded and put on a secure server. You'll be able to observe it and go over it again and again whenever you like. And what you need, this is not mandatory. You can run Danielcode trading on any chart, but we use Trade Navigator, as you know, and our proprietary programs, Gmag, Fractalian, and the others, all run on Trade Navigator. And if you want to run Fractalian, which is our not-so-random number-generating program, it's very, very fascinating, you need the Platinum version of Trade Navigator. Now, Trade Navigator used to give that to our tutorial clients as a free upgrade. They've had a bit of a shake-up of things there, and it now costs you money to get that upgrade, but you don't need to have it at the tutorial. You might want to see what it does at the tutorial and see if it's something that's going to be useful to you. I think it's an incredibly powerful tool. I use it every day, and it's quite marvelous. So that's where we are, Greg, and we'll make a date and get started with you in the next few weeks there, and the others, of course. Hank's with us. Hank and Justin be somewhere. Jerry's with us. Jerry Winter, our supporting broker. Nice to have you with us, Jerry. Jim Brown's a new member. John Marlett, Mr. Marlett's coming to the Danielcode tutorial in Los Angeles. Matt Cutchin, long-time supporter. Marilyn, good to see you here. I love seeing all my old friends here. I mean, Norbert, some of you I know personally, others I just know from webinars, but it's absolutely great to have you with. And Tom Janovic. Tom, you and your partner haven't booked into Los Angeles yet, and if you want to be famous and in the big time, mate, you better come along. Tom's actually a broker in Florida, and his partner's up in New York. Vicky's with us. Nice to have you with us, and Bill Ford. Good to have all of you with us, folks. So let's move on. That's my greetings out of the way. Let's have a look at some of these things that are coming up. In 1 month, in fact, today is the 22nd of April in the lands down under. You're still on the 21st in the Northern Hemisphere. But in pretty well 1 month and a couple of days, we've got our US summer tutorial in El Segundo, Los Angeles. It's about a 15-minute shuttle ride from the airport. Very convenient. It's a lovely little suburb. This is Manhattan Beach, the picture you're looking at, which is about a 5-minute cab drive away. Jerry Winter actually put us onto this, Jerry. We're grateful to you. And we've had a number of tutorials at this location. It's very, very nice. There's just some great big world-class shopping center up the road, and then Manhattan Beach across the highway. Very convenient, the airport, and Hilton Garden Inn's a great place. It's very relaxed, very laid back, and we love it. So if you have any idea of taking your trading to the next level, becoming a professional trader, or making this a big part of your life, you need to come to a tutorial. One of the points that I'm often asked is, what is so different about the tutorial? Well, the website is basically a basic service. We provide signals, we provide fourth seal forecasting, but it's very good. We have a lot of clients, as you know. They're all very happy. People stay with us for years and years and years. Some like Pete Andrew, as Daryl and Glennis, Sage and Mustang, stay with us forever. Excuse me. And but the big difference is that what we're looking at primarily on the website trading is price, which is what almost everyone in the world uses to guide their trading and create their signals. And at the Danielcode tutorials, we take you into some far more sophisticated strategies than that, but we also introduce you to the concept of time. And I'm going to have more to say about that later, but start thinking about the fact that time is more important than price in markets. And it's a very unique concept. I can remember in my early days, many, many years ago, when I was trying to learn how to trade, and being an attorney, I assumed you could learn this stuff from lectures and books. That's how you learn everything in the law practice, and then they send you away with a few years practical experience, and you come out the end of the machine a reasonably competent lawyer. So I bought almost every book you could think of, and I went to seminars and tutorials all over the world by all the big names you can possibly think of. it was great, great fun, very interesting. I came away from every tutorial or seminar I went to thrilled, enjoyed the people, the gurus of the time. Some of them are still friends today, but they all had the same problem. The examples worked great, but they didn't work for me. And when I got home and tried to execute those strategies, they just didn't work. Or should I say, they didn't work well enough for what I was looking for. They were not consistent enough. And that sent me off on a whole search for the Danielcode. And this, we're talking about a time frame of years and years and years. One day I had to, in despair, I had to lock away all of my books and charts that I'd collected from all these seminars and tutorials, and decided that if I was ever going to be really good at this business, I had to find out for myself what really made markets move. This took a long time. I sat staring at charts for about 3 or 4 months, to the stage that I had bone spurs on my elbows from leaning on my desk looking at these charts. I started the search for the Danielcode, and one day I found something amazing. And I ran downstairs and said to my wife, "Eureka, I have it. This is the silver bullet." And of course, it wasn't the silver bullet at all. It was just the start of a thread. And as you pull on that thread, eventually, with enough work and perseverance, the thread starts to unravel and you find out more and more and more. And this is a process that took me years and years and years. And in the process, I started to discover about time. And time and price on a chart are the same thing. But we've now developed that to the stage that we started, as you know, with our big time signals, our forecasting, our fourth and fifth seal. It's been very amazing. But then I managed to distill all of that to the stage that we now have time signals as a completely standalone trading program, and it creates signals on daily charts, and it gives you a unique view of trend, and that's the main thing that you will learn at tutorials that you don't get at the website. It's a parallel dimension, it's a parallel universe, and it just gives you a totally new view of markets, and it's quite extraordinary. Let's move on. Here are our big horrors and hates, which we're going to deal with today. Outside bars, inside bars, opening gaps, long consolidations, and snapback reversals. They're the horrors and hates, and almost all of them cause losses in your trading account. And if we can avoid these losses in our trading account, that is the equivalent of having winning trades. If we can get rid of those drawdowns that these things give us, and by learning the strategies to trade them, how to either avoid these losses or at least to mitigate them. And that will be one of the subjects we'll be talking about today. Here you will see, as the screen changes, I've headed this slide, "It's about time." The most common about time in markets is either wrong or ignorant. My favorite is, "I don't know how to trade time, so it can't be done." And that's a very common thing, not only in trading, but in the world. Some people have knowledge, other people don't have that knowledge, and the immediate response from people who don't have that knowledge is, "I don't know how to do it, so it can't be done." And that's not right. And a very, very well-known trading teacher and guru, famous in the business actually, said to me, he was quite scornful. This is a very, very long time ago. He was very scornful of the concept of time in market trading. And he said to me, I remember it well, he actually said two interesting things. He said, the people who make the worst traders are doctors and lawyers, because they believe that what happened before will forecast what's going to happen next, which of course is a staple of the legal profession. It's based on precedent and what was the law in that case. If you can apply the same set of facts, will give you the same outcome. this chap, a lot of you will know him, was in fact a journalist who sat for his bar exams in America and failed. So he wasn't, I think he was a bit coloured in his view towards lawyers. He wanted to be a lawyer and he didn't make it. Anyway, what he said was, he said, here's the problem with time. He said, if you have a trade based on time and you go to your bank and tell them you made 3 hours of time, they won't give you any money for it. But if you go there and tell them you made 10 points in the S&P, they will be happy to lend you some money against it. You know, at the stage that you're learning about this business, you meet these people who are famous, usually for the wrong reason, as we all know. Self-promotion seems to be the key these days. You become famous for all sorts of reasons, none of which necessarily have regard to merit. But this guy was a bit like W.D. Gann. He was a great promoter and did very, very well. And that's not fair to him. He was also a pioneer and a groundbreaker of this business. But nonetheless, many years or some years after that, I started to find out about time. And it's now reached a stage that I would say to you that time is more important than price. And that's a huge edge if you become aware of it, because almost all market analysis that the rest of the world sees, the great unwashed as I call them, is based solely on price. And price, in fact, is only half of the answer. Time is the other half of the answer. And you be aware of our long-term time and price analysis through the fourth and fifth seal, which we show you on the website for those of you who are interested and want to subscribe for it. We can then teach you the use of time as a standalone trading system, create daily signals. Gentleman here has asked me, can I comment on Robert Miner's work on time and price? I know Robert. I've met him personally a couple of times, including when he came out to New Zealand some years ago. He's a lovely, lovely guy. And I think he's a very clever guy. He's a smart thinker, but he doesn't understand time. And for this reason, he doesn't really get price because he uses Fibonacci numbers. Fibonacci numbers, for those of you who see them in your trading software, most people do use it, is an absolute furphy. Fibonacci was a Greek mathematician, young guy, and one of the staple foods for the Greek people in those days was rabbit, in the same way as a lot of people have chickens, keep chickens at home, get the eggs, and then eat the meat. A staple diet of the Athenian Greeks was rabbit. And pretty well before the days of supermarkets and online delivery, you had to have your own food, catch and kill your own. And they bred rabbits. So therefore, rabbits became a terribly important part of the Greek lifestyle. It was an important part of Fibonacci's lifestyle. And what he did is he came up with an equation that gave you the optimum reproductive numbers of rabbits. And that's what the Fibonacci theorem is actually all about, that if you start off with 2 rabbits, at what rate will they reproduce under optimum conditions? So if you're interested in the fornication and reproductive habits of rabbits, I suggest that Fibonacci is where you go. If you're really serious about trading markets, then you will want to know, or you should already be aware, that all markets are defined by the Danielcode numbers and the Danielcode matrix. And the only reason that Fibonacci, in fact, works is that the 2 dominant Fibonacci numbers that they use in trading are very close to Danielcode numbers. The 61.8, the so-called golden ratio. My son has just finished his university degree, and he did a degree at Bond University in film and television, and a couple of special courses in architecture. And they've been teaching him about the golden ratio, the 61.8 Fibonacci number, which is alleged to be the most beautiful ratio of all things great and wonderful. The Greek Parthenon is alleged to be built on that ratio. Marilyn Monroe's face is alleged to be on that ratio, but in fact, 61.8 is very, very close to the Danielcode number of 59.3, which is the prime main number of the Danielcode. And that's why it works, and it works as an approximate, but the real number that the market is searching for is actually the Danielcode number of 59.3. And its alternate of 62.5. And these Danielcode numbers, there's a whole ratio of them, have nothing whatsoever to do with rabbits. Yes, as my Mr. Boojel, who asked the question, said, so it was all about that even back then. Yeah, the great circle of life, it was all about that, of course, and we're all got some interest in that at some stage in our life, some more than others. Okay, we're going to move on and talk about some of these killers for markets, outside bars. These are an infectious bunch of things. You see one, you likely to see many. We'll often see, particularly in Forex, if you get one outside bar, you'll often see it across a whole range of markets. Nicholas said it. Sorry, I didn't know your first name. Thank you for that question, Nicholas. And if you've got any questions, folks, just type them in the box at the bottom of your GoToWebinar application. It's headed questions. Just type your question in there, and I'll answer it. And particularly in Forex, you'll get a rash of these outside bars. You'll often see them in. We've had days when we've had 10, 12. 14 markets with outside bars, so they're very infectious. They are always a certain loser, and there's a number of techniques you can use. The first is you can mitigate with them with a stop and reverse, if that is possible for your trading style. And I know that you need to be a person who's able to look at your chart at least perhaps on a 2 or 3 hourly basis during the trading day to do that, but if you adopt the stop and reverse on outside bars and then exit at the first profitable close, you will find it's not a winning strategy, but it is a loss mitigation strategy. You will recoup a great deal of your losses, and often you will make a profit, because in most markets, outside bars tend to be trend reinforcers. And I'll tell you about that more when we get to look at the charts. And why outside bars occur is basically you get a time and price signal that trend is about to be interrupted. So let's assume we'll see this on the charts. The market is going up. You will get a sell signal, which is elected. That is the market is acknowledging the sell signal, and it elects it. The market's now going down. And then what happens is that all these signals are based on the assumption that demand and supply are static. And then what happens is that more demand comes back into the market and pushes the outside bar back in its original trend. And that's the usual form that outside bars take. You can sometimes get outside bars at big reversal points, very dramatic. We saw one today in coffee. Those of you who were trading the Danielcode signals, we had a nice, lovely big bar in coffee today, and that was, let me see here on the other chart, pretty nice, with $1,400 per one contract, and that was in response to the sell, the TO3 sell in coffee, posted for Wednesday, carried forward valid for Wednesday and Thursday, elected today. There's an outside bar that's also a key reversal bar, and that's one of the ones against the trend. But the most common way you see that at tops quite often, there'll almost always be a TO3 or a blue line signal. But the more common ones you see are the ones that go with the trend, that you get a time and price mature enough for a reversal. The trade is elected, and then additional demand comes into the market, and pushes the bars back in the direction of the major trend. And those ones will very, very often give you a profit on the close of that bar or on the close of the next bar. And the ones that go with the trend tend to be directional signals. You can expect another 1 to 3 days up at least. The reversal bars, the ones that signal highs and lows, themselves will also give you continuations if the time signal is made. Something I'll teach you at tutorials, but when they're made on an intermediate basis, that is that they haven't, they're not mainly a TO3 or a blue line trade, they tend to get reversed fairly quickly. And this is that's why they occur. It's not all bad news, because outside bars actually are a vital part of the forecasting structure. They're the signposts to future price action and turning points. And when your chart changes, you'll see a weekly chart of gold showing the September 2011 all-time high in gold. And the 3 red lines you see leading up, forming a nice cocked hat, a very tight cocked hat, pretty precise. At that point are 4th and 5th seal lines. These are lines that represent both time and price, and they're what we use in our long-term forecasting. In fact, I forecast that high in gold, and I was actually running a tutorial. John, please change screen to chart. You should be looking at it. It probably takes a little while to get to you, John, but you should be seeing a weekly chart of gold right now. It changes here instantly, of course, but takes a while to transmit itself to you. But let me know if that's okay for you folks. You should all be seeing a weekly chart of gold. That happened happened to be running a tutorial at the time. Yeah, Terry's on board. Thanks, Terry, for being with us. Terry can see it, our guy who runs the help desk. So that chart is up. Yeah, I was actually running a tutorial in Taupo, New Zealand, at that very time that we had the high in gold, the all-time high. And I'd actually forgotten that it was in New Zealand, but 2 weeks ago we had Under Par with us, as you can imagine. His name's Jeff, a lovely guy, him and his wife and family. I know them all. They were with us in New Zealand, and as you can gather with a username like Under Par, he's a very, very keen golfer and a very, very good golfer. And it also happened that he was a huge owner of bullion, gold bullion. And we had a blue line TO3 sell signal on the day of the high at the tutorial. And we all traded that. It was pretty exciting. And he asked me, he said, "Is that the high in gold?" And I said, "Yes, it is, for at least a considerable time." And he went out that very day and sold a huge proportion of his gold bullion up around that $1,900 plus. So he was very happy with that. That's the power of forecasting in real commercial sense, quite apart from the trading. But in constructing this chart that led to that forecast, there are a number of outside bars involved. So they are the signposts to the future. Very important to have them. We now move on to inside bars. Let's see if the screen changes for you. Yes, you should be seeing the new chart now, which is silver. Here's how you trade inside bars. Inside bars themselves are usually a time void. The market puts in inside bars. The common thinking is that there's insufficient volatility to push the bar outside the previous bar, which is called an inside bar. I have them in red on this chart, so you can easily identify them. But the common thinking is there was not sufficient volatility to push this particular bar outside the previous bar. And that's true, but they're also a proxy for a timestamp. And what the market does when it's ahead of time is it will put inside bars in there to fill in time. And when you learn about time at a Danielcode tutorial, you'll be able to see exactly where these time cycles fall and how these markets will put in inside bars to fill in time. So we call them a null or a void, and whenever there's a signal and the result of that signal the next day is an inside bar, you simply treat it as if it hasn't happened, and you carry that signal forward to the next day. Excuse me, and that's what our trade program does. So let's run through this particular chart. I'll just get our highlighter here, and that's not the one I wanted. It's not called a highlighter, it's called a spotlight, isn't it? Here's our spotlight. So we're looking at this bar here, and I'll just get that up on the other chart. So I can tell you that this, this is silver. This is the COMEX silver chart. And this particular bar that we're looking at is 0401. And from that bar, that set up the next day a daily buy in gold. Excuse me, and gold and silver and the Huey index are so correlated that a signal in any one can be executed in any other if it is elected. So if you have a signal in gold, you can execute that in silver. And if you have a signal in the Huey, you can't trade the Huey in futures. It's an index. You can trade it with options, but that's not the purpose of why we create signals in the Huey. We do that because it's so highly correlated with gold and silver that sometimes we see signals in the Huey before we see them in the actual futures contracts for gold and silver. So in the same way, if you have a signal in Huey, you can execute that in gold or silver, whichever you choose. So on this chart, on this bar we're on at the moment, which is 0401 2016, this created a daily buy signal in gold, which is correlated with silver. And the very next bar created a DC time signal buy in silver. Now, the basic rule for trading silver, trading inside bars, is that in normal circumstances you do not enter at the high or low of the inside bar. You enter at the high or low of the last bar that was not itself an inside bar. Okay, everyone got that? And that avoids a whole lot of agony in trading inside bars. Now, that's the basic rule. Of course, there are exceptions to the rule, and one of those exceptions is where the risk on entry is outside your trading parameters. And if you have a look at this silver bar here, to try and buy the high of this setup bar on which the spotlight is, you're talking about a risk of about $3,500 per one contract. That's just the size of the bar. That's the reason we don't create signals for some of these really big bars. Today's a good example. There's a number of signals that are not posted on the website because they're valid signals, but the bars are so big that they're going to be way outside everyone's risk parameter. And remember, with trading, we like to take a diversified view. Some people now call it portfolio trading, that we have a number of markets, hopefully not correlated markets, that we trade. So there are signals coming all the time in many markets, and you don't need to be stressed over forcing an entry into a market that has a big setup bar, because that will put you outside your risk parameters. So this is one of those cases that the risk on entry to there's your inside bar DC time signal and a daily buy in gold. You couldn't afford to use the normal rule of entering at the last bar that was not itself an inside bar, because that would have you entering at this high with your stop underneath this low, and that is outside your risk. So this is the only case where you break this rule and you grit your teeth and you enter at the high or the low of the inside bar, which gets you long on this bar here. And then off you go, and you actually get a small profitable close there. and if you understood time theory, you might have held it for a few more days up here. The next point I want to make to you is this failure at the of the blue line trades. Now, this is particularly so for blue line trades. It also happens in TO3 trades, but more especially in blue line trades. And when you get your blue line or TO3 trades, this bar here on which I now have the cursor, which happens to be 0414, there was a blue line sell signal in this market silver for that bar, which was elected. So we're short in this market, and the stop loss went 2 ticks above the setup bar, which is the prior bar right here, and the high of that bar was 1634.5. So your stop loss was at 1635.5, and that's the failure point. If the market trades there, this trade has failed, and you're wrong. And if you're wrong, you want to do something about it. In this case, you want to be long. So at that failure point, right there on this 2 bars along on 0415, as this market traded to the failure point, you could have had, and I recommend you did have, a stop and reverse at the failure point, which was 1635.5. The next day you got an inside bar. That's a very special inside bar. We call that a Needham inside bar, something you also learn at tutorials. And from the Needham inside bars, you tend to get a bigger than normal trade. Sage was, I posted it up on forum for you to see, was yodeling to me on Skype that the Needham inside bar had kicked in again, and that silver was just kicking off the blue lines and roaring up, and that gave you a $3,000 profitable trade. Now, recall that you lost $1,600 odd on the short trade 3 days earlier. This is the essence of trading. What happens, losses are unavoidable. There was your loss. What the market was telling us, it then went up 1 day later, right here on this bar, which is 0415, and stopped you out. Now, 99.9% of traders at that stage throw their hands in their air, say a rude word 3 times, and that's it. Okay, they've had a losing trade and they're going to mope about it. That's not how you trade. The market is telling you something all the time, and you need to be as close to the market as you can, following what it's telling you. We have no idea what markets are going to do in the future, and anyone who tells you that they do is telling lies. It is not for us to have foreknowledge of what markets do, but how we trade is we have many well-known things that markets do again and again and again that we've tested for years and years. And what we do is when the markets do that action, we have a reaction to it. And that's what we're doing. We're reacting to what the market is telling us. And at this point here, we had time and price, which is what created the blue line sell signal. Time was right. We had price at a very important Danielcode price level. We had our blue line signal. It was duly elected. Now that means that everything was mature enough and ready for a downside reversal, and it doesn't happen in the same way that new demand comes in to create outside bars. New demand came in here to create the failure. But if you knew where the failure point was, which is at your stop on your initial stop loss, if the market breaches that, it's a very, very high probability that all we've seen is a 1 to 3 day counter trend, in this case a 1 day counter trend, and the market is going to go higher. And you get the Needham inside bar, which tells you that if this trade is elected, which in this case it already has been the day before, if it continues upside, it's going to be a big move. So yes, we lost $1,600 on the sell that didn't stick, but we got all that back plus more with a $3,000 trade 2 days later. But to get that trade, you had to know about the failure point and stop and reverse at the failure point. And you will see this, prove it to yourself, look at it on your charts. You will see this also in TO3 charts. but particularly on the blue line trades. Let's move on. This is a chart I showed you 2 weeks ago. This is what we call waterfalls, and the opposite of waterfalls, which Sage has named staircases. So we will, oh yes, and Sage has just told me that was also a hook. That was a Danielcode hook trade in silver that was went the other way. Thanks, Sage. This is a chart I showed you 2 weeks ago of waterfalls and gaps in crude oil. And all of these major moves have a common pattern, and it's getting pretty close to a 90% probability that all of these big moves run off these waterfall patterns, or the inverse going up, which Sage has christened staircases. And so we shall adopt that terminology for Sage. And this has created quite a lot of interest because, as you can see, it's just tremendous trading. And there are 2 ways you can use this. Either you can use it as a unique view of trend, or else you can even examine the probability of trading. Those of you who like to hold trades for a long time, you can trade waterfall signal to staircase signal, but you do need appropriate stop loss technique. More of that at another time, but just to show you that importance of gaps. So the fourth seal, those of you who subscribe to it or have done a tutorial, most people commonly think of this as forecasting turning point, which is what it does. But what it also does is it gives you a unique view of trend that's not available to the great unwashed. And if you have that, as I've shown you in previous webinars, if you bias your signal towards the trend and either don't take or simply use the trades against the trend to activate your stop loss, you get a massive geometric improvement in your equity curve, your profits. And in that same way, we can now see trend from time alone. And we now have another unique view of trend, and this is the time trend. And we should have had a chart change here. You should now be looking at the S&P E-mini chart. And the important part of this chart is that we have this, what looked to be at the time a terribly important low, that looked to be the trend ending low. And that's this bar here, over here, which was January the 20th. This is not the time trend low. It actually is the time trend low on most conventional analysis. It's the trend low on most conventional analysis. And this leads us into the fascinating topic of overbalance. We can get an overbalance in time, and we can get an overbalance in price. This is a very, very old concept. If you go back through the 40s and 50s, and a lot of the material that was published about trading in those days, which is all written because they didn't have the internet, thank goodness, you can see there was a lot of interest in this idea of an overbalance in time and an overbalance in price. And I got interested in that, as I get interested in all these old ideas, and worked out how they did it. Gann was one of them who was interested in that. And I found out, like most things of W.D. Gann's, it was a great idea. It had a small element of truth in it, but basically it didn't work. And it didn't work because Mr. Gann didn't know how to measure time properly, or if he did know, he certainly didn't tell us. And I've since then been working up this concept of an overbalance in time and price. And it's now become incredibly real with these time trends, which tie into the question of waterfall and staircase trends, that they are all, in fact, an overbalance of time and price. And on a normal analysis, normal conventional price analysis, this run up here from this low up to this high, that is from January the 20th on the S&P EM mini chart, up to the February '01 high would appear on all conventional analysis to be an overbalance of both time and price. In other words, it's a rally that is longer in time and bigger in price than any previous rally in the operating swing, which runs from this high way back here down to this low. But in fact, that's what's wrong with the theory. It's not an overbalance of time and price, and you can't see that unless you can accurately visualize with tools the escalation and the divisions of time which we teach you at tutorial. So in fact, that was just a rally. And this bar here, which is 0211, is in fact the time trend low. And I was talking to a client about this yesterday. It's also a hook trade. Okay, in fact, it's the very best sort of a hook trade. It's a false break. It's 100% of the previous low plus about 1.5 points, which is the typical way that markets clean out all of the stops. So that's a Danielcode hook trade as well as a time signal buy. And for the whole of this move in the S&P, from that low, which was back in February the 11th, till today, the time trend has stayed up for this whole period. And you can see if you had biased your trades towards the buy side, there's a buy signal there, there's one there, there's another one there, there's another one here, there's another one here, there's one here, there's one here. That's an outside bar, that's gone. And right here there was another one, and this was an outside bar which you probably didn't get into, but of all of those trades to the upside, they're all profitable from February 11th on. And on the downside trades against the time trend, hardly any of them are profitable. This little bar here gives you a profitable close, this gives you a profitable close, this one doesn't, this one does, and in here if you tried to sell this, you got into a mess. So being able to view the trend in another way, not based on price, is quite unique because you have a view of the market that other people don't have. And when you have an edge in this business, it multiplies geometrically. It's a huge benefit. So those of you that are interested in these sophisticated trading concepts, make sure you shoot me an email and let me know that you'd like to either come to the Los Angeles tutorial next month, or if you really can't get there, we can do it by video. I prefer to meet you personally. I think you do get more out of it personally because we talk about trading all the time, not just in the hours that I'm teaching, but we have drinks and small eats afterwards, and we often have breakfast together, lunch together. There's trading talk going on all the time. So if you can get to the tutorial, personally, I certainly recommend it's worth the effort. And if you can't, we can do it for you by video, which works very well. Okay, so let's move on and see what we've got here. I showed you this 2 weeks ago. I've left this slide here to show you the various stop loss strategies, because one of the things you get into when you get an outside bar, it's often a very big bar. So you put on, let us say, your sell order, and the trade gets selected. When it reaches the failure point, which is the exact point where an outside bar is created, that's also the same point where the failure of the sell side trade reached. You need to be long if you can. If you are able to look at your charts during the day, you need to have a stop and reverse at that point. Then you're left without a stop loss. So your stop loss traditionally should go at the intraday low of the bar. Very often you will find the risk on that is too much, and the simple way to do it is to use a dollar fixed stop. So work out as a percentage of your trading what you're comfortable with in dollar terms, and put that on as a dollar fixed stop. And that's the best way to put on a stop when you've executed a stop and reverse on an outside bar, because very often with outside bars they're so big that you really are way outside your risk parameter if you put your stop underneath the intraday low. This is the Hilton Garden Inn at El Segundo, where we're going to be next month. Love to see you there. If you're serious about trading, taking your trading to the next level, you should be there. Shoot me an email, please, jneedham@thedanielcode.com, if you're interested in coming to the tutorial, or if you would like to have that knowledge but you're unable to attend personally, let me know and we can organize the tutorial by video for you. This is the link here, folks, for booking your accommodation at the Hilton, and we really should be booked by now or getting close to it. We have to give them final numbers a month out from the tutorial, so that's a couple of days from now. I don't think that I think you can book after that. If you decide later on you can come, but I have to guarantee a certain number of rooms, so I do urge you, if you're coming, to go ahead and make your booking at the Hilton Garden Inn, and I'm really going to look forward to seeing you there. And we're just going to move on here. I've got a couple of questions. I'm going to come back, Jim. I'm going to deal with your question and any others. If you are not already a Danielcode member, you're most welcome to take a free trial. You simply go to the website and click on the free trial button and register a username and a password. You then email your username to Terry at support@thedanielcode.com, and he will be happy to give you a 31-day free trial of everything we have on the website. We open the whole thing up to you so you can see the various services we provide, including the Fourth Seal and others, and then you can decide for yourself which of our services might suit you, and go from there. If you haven't already had a free trial of Trade Navigator, Charts and Software, Terry can organize a free trial of Trade Navigator software and charts for you as well, and he'll be happy to do that. Here's our compliance document, which I'm required to show you, and I'm happy to show you every week to remind you that trading has inherent risks and you can lose a lot of money very quickly trading futures and spot forex, and you will lose it extremely quickly if you don't know about Danielcode trading. And once we've taught you to trade safely and profitably, those risks decrease dramatically, but most people who are new to trading want to tear into it without taking the time for learning. I'm an attorney, as many of you will know, and I said to one of my clients yesterday, learning this stuff is considerably harder than getting a university degree. And how many people actually put in the time and the effort that you had to for your final school exams or your university exams? This is on a par to it, and this is a great business for a particular reason, that it rewards those who put in the work. The more you work, the better you'll be at this. One of our very best traders is Glennis. I've told you about her, Sister Sage. And another very, very good trader is Frank DB, who assists me with the fourth and fifth seal chart. And Frank came to a tutorial with his lovely wife, Anne, when they were newly married. I think it was just, it might have even been their honeymoon in New Zealand. They came from Belgium, and he knew nothing about trading, and came to me with a completely open mind, and got really hooked on it. He got very excited, particularly about the fourth and fifth seal forecasting, which he uses the trend from the fourth seal as part of his preparation of daily trade signals. He's got so good at it that he now assists me in preparing the fourth and fifth seal forecast that you see all the time. So this is a game that rewards diligence. and the harder you work, the better you'll be at it. Let me just get out of here so I can. We can get rid of this now, and we can go and take a look at our charts. This is one of the other things we need to talk about: opening gaps, long consolidations, and snapback reversals are the three other horrors. And this is a horror. This happened on Monday. There's a huge gap under here. This market gapped down from this low to the open. So it gapped down $333. You weren't actually trying to sell this market. This is Euro JPY. Let me see what we had on it. Euro JPY. We actually had a buy, a nice blue line buy on this. So we got long at this after this high here. We got long on Tuesday. But this is a complete furphy. This happened on Monday. Forex, as you know, trades continuously, 24 hours a day, and it's only closed on the weekend. So the only time the market is closed for Forex is on the weekend. And these gaps traditionally will come in Forex. They come on a Monday because they're news related. And they're an absolute nonsense. This particular one, let me show you what it was caused by, was all about oil. And the world is full of, this is it here. This was the gap. It was on Monday. It was also rollover day. This market rolled to the June contract. And if we look at the June contract, you can see this massive gap down here. And what this was caused by, there's the gap, $1,350 worth of gap. What it was caused by is negotiations about trying to bring some stability and order into the oil market was going on in Doha, which is a very nice place that they often have these big important meetings at, and all the Arab oil producers were there, and the media buzz was that they were going to cap production to limit all of this huge downside that oil has had. And the theory was that as it was going up, there was a belief that they were going to be successful in capping production. Then when they decided they wouldn't, the market was disappointed and had this big gap down. Now, that is absolute rubbish. Okay, first of all, you wouldn't know what these guys agreed, and you certainly wouldn't know if they're going to implement any strategies that they might have agreed on. The history of oil production is that there is very, very little truth in whatever announcements they make. They're largely posturing. It takes long periods of time to ramp up oil production. Sometimes it means new equipment, and similarly, none of them want to close down their oil production because even when they're not getting much money for it, or what they would consider not much money, $40 a barrel for oil, I would have thought was myself is quite enough money, but nonetheless, they will keep producing it. So this whole blurb in the media is absolute rubbish. But the world is full of people who sit there poised on their 1 or 3 minute charts waiting to trade news, and they're very bad traders and they almost always lose money. But this gap came as a result of that. And where do you see it most? Have a look at this. This is the USD JPY. This is the carry trade. Okay, what the various reserve banks in America and Japan have done is they've made it very, very cheap with low interest rates to borrow money, particularly in Japanese yen. That's Trade Navigator died. Let's see if it'll come back. No, it won't, so we'll have to close that and reopen it. That happens occasionally, folks. Probably happened to you. Very annoying, isn't it? It'll reopen in a minute or two. The big institutions, the big corporates, not you or me, I should add, the big institutions can borrow substantial amounts of money in Japanese yen at very, very low interest rates. And the yen US dollar pair is the preferred funding method for the see if we can get these charts back, for the carry trade. Okay, so we were looking at euro, we were looking at USD Japanese yen. We'll try it again and hope it holds up. There you are. So this gap down at the open of this Forex market, which coincides with a rollover in oil and all sorts of other markets, even the equities, carries through, it ripples through. There's no reason for it. It's absolutely stupid. There's no commercial reason for it, because if you get to the stage of believing what Arab oil producers might or might not be saying in a public press release, you really are in la-la land. But nonetheless, there's a whole lot of people who thrive on that stuff, and it's not clever. The next thing, what you can do on gaps, particularly be aware of this on Monday mornings, because all the markets are closed over the weekend. Most of these markets now, more and more of them are becoming continuous markets, where everything that's happening is actually reflected in the market. But Monday mornings, if you want to, this is not, you are not trying to sell any of these markets, but what we had, in fact, for, let me see, this was Monday. We didn't have signals for oil because it was on rollover. And we don't put up signals a few days before and the day or so afterwards on oil. But you can use what's called a stop limit order. And normally, if you put your order on stop, let me see if I can make it display it visually for you here. If you were buying this bar here, which was April the 5th, because it was be a Danielcode buy signal of some sort or other. It certainly is a time signal. Looks like it was a price signal as well. The high of that bar was 36.58. So your, I think this thing just moved in hundredths, 58. Your buy order was at 36.60, 2 ticks above the high of your entry bar. You can put what's called a stop limit order on. Now, a stop loss order, when the market trades to that number, doesn't mean you're going to get filled at 36.60, but when the market has traded to that number, your stop order becomes a market order. That is, the broker or the platform these days will take it to market as soon as they can. And of course, you'll be in a queue. You're queued for priority depending on when you place the signal, which is why we go to so much trouble to get the Danielcode signals up on the website 2 hours after the markets close. We get the data from Trade Navigator around about 6:30 US Eastern Time, or in the following 20 minutes, and we will have those signals posted an hour after we get the data. And that's so you can get your signals on early and be well advanced in the queue, so you get better fills. But what you can do is you can then use a stop limit order. You can work out a percentage. I use a percentage of the average daily true range, and on weekends in particular, any other time you like, you can do this. You can put what's called a stop limit order on. This is just to give you a visual. You might say, I want to buy at 36.60 on stop, 37.02 limit, which means you've got to be filled inside that price range. If the market gets past that price range, if you're not filled, the order will be abandoned. Now, this doesn't apply when the markets are trading through it like this, but it certainly applied for all of these. Let me see if I can show you a better example. It applied for these markets that gap down. Here's one. This is actually gasoline. It's a market I trade a lot. It's a fantastic market. For those of you who are not trading, have a look at it. It's volatile, but it's a commercial market, which means it has a very high tick value to the average daily range. The non-commercial markets, the markets that the public trade all the time, gold, S&P, E-mini, those sorts of markets that the public are trading extensively, they have a very low ratio of tick value to average daily bars, because they're trying to minimize the volatility to brokers of incurring a loss. Exchanges don't really care about you and me as traders. They do care about brokers, who are their primary clients and largely their owners. But this is a real commercial market. The risk ratio in this is fantastic. And here's a huge gap down. And a gap like that, if you were trying to sell this bar, and I don't know why you would be, the sell signal was before that, but you can see here this tool's not working. Trade Navigator is having a heart attack, was about $1,280, just the risk there. So on Mondays, it's really worth taking the time to construct a stop limit order. And if you'd like to know more about that, talk to your broker. And if you don't have a broker, talk to Jerry Winter, who should be your broker anyway. Anyway, Jerry will certainly talk to you more about that. He's a deep expert in that. The next two matters on this agenda we had here were long consolidations. And I want to show you this, if this chart will hold up with Trade Navigator. This is oil. Let's scrunch it up so I can show you what I want to show you. We can get rid of these two little things there. We should, in fact, have more color on this chart. But this was the classic case here. Here's oil. This was this big rundown. This is a waterfall pattern at this high, folks. It's typically what you get before you get these really extended moves down, which was quite fabulous here. This was just wonderful bit of trading out the waterfall. You got most of this whole run down. But then what happens is markets get shocked. And this market got shocked. And then you had this massive, great big snapback rally up here. And if you put on your Danielcode trading channel, from there you will be able to see that from that bar, which was August the 31st, 2015, until this bar, which was October the 6th, this market went sideways, completely sideways. And in this whole process, from August 31st, let's go to the next bar, let's say September the 1st, until October the 5th, a whole month, there's only two winning trades in this whole period, okay? And once these markets start to consolidate after a really fast move, they can have very long consolidations. In fact, this consolidation goes on until October the 27th, when you have this small breakout bar here, rally up, and the downtrend continues. So that seems to me that Trade Navigator is having a heart attack. See if I can. Snapback reversals is the other thing I have to talk to you about, and we'll have to leave that to another day. But just be aware that when bars are making historic type sizes, they can't go on forever. Trade Navigator is definitely having a heart attack today. And I'm not going to be able to show you that, which is a shame. We'll put that on the agenda for next week, and I'm not going to be able to show you anything, in fact, because the charts have died. So, Nicholas, do I ever use candlesticks for easier reading? Yes, I do, mate. I love candlesticks, and I have a fairly large supply of them in my house. And when the power fails, I light a couple of candles, and I sit here when the power's off, and I read by candlelight. And that's all that candlesticks are for. Candlestick bars were created hundreds of years ago, thousands of years ago, for the Japanese rice trade. And if you want to know all about it, I will show you. You can go to the Danielcode website, and you can click on articles. You'll find about 80 or so articles here that I've had published back in the days when I used to be a very, very vigorous writer. I was full of rage and anger at the world, and I used to write all the time. Now, let me see if I can find it for you. You can see that there's a heap of published articles here, and if you read all about these, if you read all of them, you would really be a very, very good trader. Why can't I find it? It's called this is it, Samurai Trader. Okay, so we need an authentication required. I can't remember what my username is, but I will get Terry to make sure this is available on our website for you, and it tells you all about the first of the great rice traders and how he used candlesticks to trade rice, and they were very good for that apparently. They're no good for anything else. A lot of people use them. I don't really know why. I know that you see all sorts of patterns in them. In my view, you might as well lie on your back and look at the clouds and see what patterns you're getting. They're not reliable. Markets are moved entirely by time and by numbers, and you can see those best with your normal bars. So seeing as we seem to be having all sorts of technology problems today, Trade Navigator has died. I'm unable, Jim, to show you the analysis of silver, but I will put it on the agenda and make sure I deal with it at our next tutorial, next webinar, should I say, which will be in 2 weeks' time. And I look forward to seeing you then, folks, and having you with us. And thank you for your company today. I hope you've found this material interesting. Okay, so final reminder, if you're coming to the tutorial, please shoot me off a email so I know to expect you, and we can fix it up from there. Dex, thank you, mate. Great to see you here. Glad you're with us again. All right, folks, with that, I'm going to end the tutorial. I thank you for your attention. It's Friday afternoon down here. It's sunny and warm, which means it's time for some Bloody Marys. And for the rest of you, I wish you a great weekend. Bye-bye for now.